Hey everyone, it's Tony, the Geeky agent from Remax, just checking in with you. There's been a lot of talk today about changes coming to mortgage rules in Canada, announced by the federal Liberal government. And a lot of people are just sort of posting articles and all this kind of stuff, not really explaining very much. So we thought I'd take a few seconds to sort of straighten things out, at least in a very basic way for you. If you really need to, we can always get you hooked up with a mortgage professional, mortgage broker, or a mortgage professional at a bank and that sort of thing to really go over your particular numbers and have a look at what exactly it is or how you're going to be affected by these changes in the mortgage rules. Basically what's happening is there's about 3 or 4 different things that are happening. Not all of them are going to be applicable to everyone. So what's happening right now currently is that anybody who obtains a high ratio mortgage, so if you're putting down less than 20% on the purchase of your home, which the minimum is usually 5%, you have to get insurance. So you're getting insured by CMHC or Genworth or something like that. And basically what that does is it gives insurance to the banks so that because you have very little equity in your home, you're somewhat of a high risk. So the banks want insurance. So they'll lend you the money to get you a house, but they want to be insured that they're not going to lose all their money if you happen to default on your mortgage. Now this is done through CMHC and Genworth and all that stuff. So they provide insurance to the lenders to make sure that if you do happen to default on your mortgage, the banks are covered, the lenders are covered. But in order to do that, what they want to do is test you as far as what's your risk tolerance. So the bank might be providing you an interest rate right now of about 2.2%, say, on your mortgage. But they want to make sure that if things change in the future, so if the interest rates jump by 1% or 2%, that you're still going to be able to pay your mortgage. So they test you based on the average posted rate, which right now is about 4.64% for a 5-year fixed mortgage. If you can still qualify for that mortgage at that interest rate, then they'll go ahead and give the banks the insurance and you can go ahead and purchase the home. If you can't, then they'll deny that mortgage. So you have to be looking to purchase a home that's worth less money. Right now, that's, again, like I mentioned, only being applied to people with less than 20% down payment. They're basically taking that rule and applying it to people that even have more than 20% down payment, but where the banks are seeking that insurance. Because the banks can still get insurance for people who have more than 20% down payment if it's a really, I want to say, risky situation, basically. If you're really stretching the limit of how much you're borrowing, like if you're right at the edge of how much you're about to borrow and the banks are a bit nervous about you possibly defaulting on that amount, they can apply to CMHC and other bodies for that same insurance. Up until now, they just applied and they've got the insurance because you have a big chunk of equity, you have 20% or more down, and just sort of gone ahead and given you that insurance. What they're doing right now is saying, no, you're going to have to go through the same stress test that we're putting the people with less than 20% down on. So you're going to have to go and be approved for that high mortgage, or that low ratio mortgage is what they call it. But you're going to have to qualify at the higher posted interest rate of 4.64%, even though the bank's giving you 2.2 or 2.3%, for the exact same reason that if in 6 months from now or a year from now or 2 years from now, in the middle of your 4 or 5 year term, whatever it happens to be, the interest rates go up by 1% or 2%, they want to make sure that you're still going to be able financially to pay for your mortgage and your heating bills and everything else that you need to pay for and not default on this mortgage. And the banks will have the insurance to make sure that's the case. The government essentially is protecting itself because at the end of the day, we, the taxpayers, cover this insurance plan. It comes from our taxpayer money. So if people start defaulting on all these mortgages, suddenly CMHC, which is funded by the government, is on the hook for this money, which comes from us. So they want to sort of protect us a little bit more, seeing as how in certain areas of the country, like Toronto and Vancouver, house prices are just a little insane. And the exposure might be a bit high there. This is not a real estate bubble. This is the government just sort of protecting themselves and taxpayers from overexposure in this particularly hot housing market, which is a good thing. And they're protecting taxpayers, they're protecting themselves. They're making sure that people can afford the houses that they're buying. This is pretty much a basic rule of thumb that I've given to my buyer clients since I started in real estate almost 5 years ago, and I've always used it for myself. It's like, I love getting low interest rates, but what if interest rates go up? Am I still going to be able to live in my house in 5 years when I renew my mortgage if the interest rate is 2% higher? So I always sort of judge my payments based on that, and that's a good rule of thumb for everybody to use. Aside from that, who's being affected is they're closing some loopholes on capital gains. But basically, there is a loophole right now. Well, it's not really a loophole, I guess, but some people are using it as a loophole where if you sell your primary residence, if you sell your home, you don't have to pay taxes on the profit you make. So if you bought your house 10 years ago for $300,000 and now it's worth $500,000, you just made $200,000 on your house, minus the interest you paid on your mortgage and everything else, right? But for basic numbers, we'll say you made $200,000 on your house. Normally, if that was a profit and you're in a business, you have to pay tax on that. You pay what's called capital gains. Your house, the property that you own, has increased in value. You made money. You have to pay tax. There's an exemption for that when it's your primary residence, when it's your house. The issue is that people take advantage of that. Specifically, what they're looking at is foreign buyers. So people from outside the country. China usually gets a bad rap for this, but people from all countries all around the world do this because Canada is a very stable economy. So they'll contact local people here. They may even come to the country and look for a home, purchase a property, but they have no intention of living here. So they go back to whatever country they're from, or their local real estate agent here helps them purchase a property. They then hire contractors to renovate it, flip it, eventually, and sell it. In the meantime, they claim that this is their primary residence here in Canada. It's the only place that they own here in Canada, which it really is not. This is all being done for profit. So what the government is doing is closing that loophole. So if you don't actually live here, if the house remains vacant, you can't claim that capital gains exemption. The only pain for regular homeowners, I guess, at this point, is that when you do sell your house right now, you don't have to indicate that on your income tax returns. Going forward, in the year that you sell your house, you'll have to indicate that, yes, I sold my property, here's the address of the property, and possibly include some other information about the sale of the property. What you might have to include what you originally purchased it for and what you ended up selling it for. But because it's your primary residence, you're not going to have to pay taxes on it. However, these foreign buyers who are not Canadian residents, when they have to file these tax returns, will have to pay capital gains tax on any profit that they make. And people who use this loophole sort of to flip a number of different houses in the same year. So you'll sometimes see a married couple and they'll put their primary residence in the wife's name, and then the husband will go off and purchase a property and put it in his name, claiming that it's his primary residence. Well, the intent the entire time is basically just to buy properties to flip. So they'll work on it, renovate it, turn around, sell it, claim that they sold a primary residence, so they avoid having to pay capital gains tax. They'll have to include that on their tax returns. And generally speaking, husband and wives file joint returns kind of thing. So if you see two different primary residences show up, if you see 2 or 3 primary residences show up in a year because we're flipping 2 or 3 houses in a year, chances are the Canada Revenue Agency might want to talk to you about that and may want to launch an audit on you. So they're trying to clamp down on these people sort of who are using the loophole or using the exemption, I guess. I hate calling it a loophole because it's not really, but they're using this exemption in essentially an illegal way to avoid paying taxes. So really that's what's happening there, and that covers a couple of different things. Aside from that, there's been a bunch of rule changes in the past couple of years that have changed things in the market. Essentially, what they're trying to do is protect the government and protect taxpayers. It's a good thing. It's something they probably should have done a long time ago, to be honest with you. There really is no impact. What's happening is if you're really trying to push how much you can afford for a home, chances are you might have to scale back. And that's not a bad thing, because what they're really trying to control is that small percentage of people right on the edge of the bubble who are really living paycheck to paycheck to pay for their home because they just want to buy something that's well beyond what they can afford. And they are the ones who would be most negatively impacted if the interest rates do change. There are a lot of indications right now that in the United States, the Federal Reserve is actually looking at increasing interest rates for the first time in a very long time within the next 12 months. Generally speaking, it doesn't always happen, but the chances are pretty good that the Canadian Bank of Canada essentially will follow suit. Maybe not to the same extent, but you can see a leveling off or an increasing of interest rates probably in the next year or two for sure. 2% interest rate. We're almost at negative interest rates at this point at lending, and that doesn't work well. Generally speaking, in economic terms and for the long term, So that's generally what's happening there. If you have any other questions about it and you want to talk to me directly, chat, see how it might be affecting you, please feel free to contact me, private message me here, send me an email at tony@thegeekyagent.com, text or call me 289-237-9896. If you'd like me to get you hooked up with a mortgage professional that I recommend, and I generally only recommend people that I've worked with and who I've had discussions with, so I know that they know what they're talking about. Please feel free to private message me. I have contacts at all the different banking institutions and a number of different brokers I can refer you to that will steer you in the right direction and make sure you're heading in the right direction. A lot of people are going to be racing to get approvals in the next couple of weeks before the law takes effect. You can go ahead and do that if you want. Again, but I use the same rule of thumb that I've always used. And I tell all my clients, it's like, if you can't afford the mortgage at 1% higher than what you're being approved for, chances are you might want to reconsider what you're doing. But at the end of the day, it's always up to you. So be careful when you're out there. Don't overextend yourself. Don't live beyond your means. That's good advice that I always heard. And if you have any other questions, like I said, feel free to contact me. And as always, until next time, I hope you have a great day, and I'll talk to you soon.